The most expensive financial mistake you will ever make will likely happen on the worst day of your life, and the government is quietly counting on it. Right now, built directly into the United States tax code, is a silent mathematical trap that targets married couples over the age of 60. Financial advisors almost never talk about it. The IRS certainly isn't going to send you a warning letter about it, and if you do not prepare for it while you and your spouse are both still alive, it can legally strip hundreds of thousands of dollars away from your surviving spouse and your children. It is called the widow's penalty. Most people think that when a spouse passes away, the surviving partner's financial life gets a little bit easier from a tax perspective because their income usually goes down. One Social Security check stops, maybe a pension gets reduced. You would think the tax bill goes down too. It doesn't, it explodes. The moment you lose your spouse, your tax brackets get cut in half, your standard deduction vanishes, your Medicare premiums can suddenly skyrocket, and worst of all, the banking algorithms we've talked about on this channel can literally freeze your access to your own life savings while you are trying to pay for a funeral. The government effectively penalizes you for becoming a widow or widower. My name is your name, and I am an enrolled agent tax professional financial educator. I sit across the table from people every single week, and I will tell you the single most painful thing I see. It is not people losing money in the stock market. It is watching a grieving 75-year-old widow find out that the IRS is about to take 30% more of her money on the exact same retirement income she and her husband lived on the year before. But here is the good news. This is not a warning about a permanent disaster. This is a survival guide, because if you understand the rules of the game, you can opt out of it. In the next 25 minutes, I am going to walk you through the math of the widow's penalty so you can see exactly how it works. Then I am going to give you the 4 specific, 100% legal protection moves you need to put in place right now, this week, while you and your spouse are both alive and healthy. These 4 moves will build a permanent tax-free shield around your remaining wealth. Grab a pen, take notes, let's get started. Before I give you the 4 protection moves, I have to tell you the story of Robert and Susan, because their story is the clearest example of how fast this trap springs on people who did absolutely nothing wrong. Robert and Susan were married for 42 years. They lived in Ohio. They were not ultra-rich, but they were comfortable. They had 2 Social Security checks, a pension from Robert's years at the phone company, and required minimum distributions coming out of Robert's 401k. Together they brought in exactly $100,000 a year in taxable income. As a married couple filing jointly, the tax code treated them beautifully. They got a massive standard deduction. Their income sat comfortably in the low 12% tax bracket. They paid their taxes, they enjoyed their retirement, and they never worried about the IRS. Then Robert passed away suddenly at age 74. Susan was devastated. For the rest of that year, she grieved. She didn't think about taxes. Why would she? When January rolled around, she took her paperwork to her CPA. Robert's Social Security check had stopped, so her total income had dropped from $100,000 down to about $80,000. Susan assumed her tax bill would go down. Her CPA looked at her and said, "Susan, your tax bill isn't going down, it's almost doubling." Susan thought it was a mistake. It wasn't. It was the tax code working exactly as Congress wrote it. Here is the math. When you are married, the IRS gives you a wide, generous tax bracket. You get to file as married filing jointly. In 2024, a married couple gets a standard deduction of nearly $30,000, and they can earn up to about $94,000 and still stay in the low 12% tax bracket. But the year after your spouse dies, your filing status changes to single. Instantly, that massive $30,000 standard deduction gets chopped in half. But it gets worse. The tax brackets themselves are cut in half. As a single filer, the 12% tax bracket stops at just $47,000. Every dollar Susan earned over that amount was suddenly pushed into the 22% and 24% tax brackets. Think about that. Susan's income went down, but because she was forced into the single filer tax brackets, her tax rate effectively doubled on a huge chunk of her money. The IRS pushed her into a tax bracket designed for high-income single professionals simply because her husband died. This is the widow's penalty. It happens automatically, And if most of your retirement money is sitting in a traditional 401k or traditional IRA accounts where you haven't paid the taxes yet, the IRS is going to feast on your surviving spouse. We are not going to let that happen to you. Here is how you stop it. Protection move number 1 is the Roth conversion shield, and this is the single most powerful strategy in this entire video. If you are watching this and you are married, right now you are in the best tax position you will ever be in. You have the wide tax brackets, you have the double standard deduction. The strategy is to pay the tax now at the low married rate, so your surviving spouse never has to pay the tax at the high single rate. Let me explain exactly how you do this. It's called a Roth conversion ladder. Most retirees have their money in pre-tax accounts. Traditional IRAs, 401ks, 403bs, that means you owe the IRS a cut of every dollar you pull out. If you leave all that money in there and you pass away, your spouse is going to have to pull that money out to survive, and they will be taxed at that brutal single filer rate. Instead, you start looking at your tax return this year. Let's say you and your spouse make $70,000 a year. You are in the 12% tax bracket. That 12% bracket goes all the way up to $94,000. That means you have $24,000 of empty space inside that low tax bracket. Every single year you proactively take $24,000 out of your traditional IRA, you pay a measly 12% tax on it, and you move it into a Roth IRA. Once that money is in the Roth IRA, it is legally untouchable by the IRS, it grows tax-free, and it comes out tax-free forever. If you do this for 5, 6, or 7 years while you are both healthy, you will shift hundreds of thousands of dollars from taxable accounts into tax-free accounts. Then when the tragic day comes and one of you passes away, the surviving spouse doesn't have to pull money from the taxable account. They can pull their living expenses from the Roth IRA. Money pulled from a Roth IRA does not count as taxable income. It does not push your widow or widower into a higher tax bracket. It completely bypasses the widow's penalty. Most people never do this because they hate the idea of paying taxes voluntarily. I hear it all the time. Why would I pay taxes today if I don't have to? Because you are buying a discount. You are paying 12% today so your wife or husband doesn't have to pay 24% tomorrow when they are grieving and alone. You are paying the tax on the seed so your family doesn't get taxed on the harvest. Protection move number 2 deals with the silent side effect of the widow's penalty, and this one makes people furious when they find out about it. It's the Medicare surcharge. A lot of retirees assume Medicare is a fixed cost. It is not. What you pay for Medicare Part B and Part D is tied directly to your taxable income through something called IRMA, the income-related monthly adjustment amount. If your income goes too high, the government tax a massive surcharge onto your Medicare premiums. But here is the trap. Medicare does not look at your income this year. They look at your tax return from 2 years ago. Let's go back to Susan. Robert dies, her income drops. But 2 years later, she gets a letter from the Social Security Administration telling her that her Medicare premiums are doubling. Why? Because the government is looking at the tax return from 2 years ago, the year Robert was still alive, the year Robert's life insurance paid out, the year they sold a property, the year her income temporarily spiked. The government algorithm sees that high income, doesn't realize Robert is dead, and hits the widow with a luxury tax on her health care. And because it gets deducted quietly from your Social Security check, most widows just pay it without realizing they are being robbed. Do not accept this. You do not have to pay it. There is a specific form sitting on the government's own website that is designed to fix this, and almost nobody files it because nobody tells you it exists. It is called for MESA 44, Medicare Income-Related Monthly Adjustment Amount Life-Changing Event. The government actually has a list of what they consider a life-changing event that legally entitles you to a premium reduction. Death of a spouse is right at the top of the list. If you lose your spouse or if your parent loses their spouse, you do not just accept the Medicare premium increase. You print out for MESA 44. You check the box for death of spouse. You provide an estimate of what your new lower single income is going to be, and you force the government to recalculate your premium based on your reality today, not your joint income from 2 years ago. I have seen this one single piece of paper put $3,000, $4,000, even $5,000 a year back into the pocket of a widow. It is your right, use it. Now let's talk about the banks, because if you have watched my videos on the new $10,000 bank reporting rules, you know that bank compliance software has gotten wildly aggressive in the last 24 months, and the absolute worst time to trigger a bank freeze is the week your spouse dies. Protection move number 3 is keeping your money out of probate court. Here is what happens every single day in America. A husband and wife have their money split up. Maybe the husband has a checking account in his name only where his pension goes. Maybe the wife has a savings account she's had since before they were married. The husband passes away. The wife goes to the bank to withdraw $15,000 to pay the funeral director. She slides the death certificate across the counter, and the bank teller looks at her and says, "I am so sorry for your loss, ma'am, but your name is not on this account. I have to freeze these funds until you go through probate." Suddenly, her own family's money is locked behind a legal wall. It can take 6 months, 9 months, or a year to get a judge to release the funds. In the meantime, the widow has to borrow money or put funeral expenses on a credit card at 24% interest. This is entirely avoidable. You can fix this tomorrow morning in 15 minutes for free. You need to walk into your bank branch, sit down with the manager, and ensure that every single account you own has a TOD transfer on death or POD payable on death designation attached to it. A TOD designation supersedes a will. It bypasses probate court entirely. If an account has a transfer on death designation naming your spouse, the moment you pass away, that money legally becomes theirs. The bank cannot freeze it, the bank cannot hold it hostage, the courts cannot touch it. The widow walks in with the death certificate, and her ID, and the funds are instantly released. Do not assume your accounts are set up this way just because you are married. I cannot tell you how many people think, "Oh, I have a will, I'm fine." A will has to go through probate, a TOD does not. Go to your bank, ask the teller, "Are my accounts set up as payable on death to my spouse?" If the answer is no, sign the paperwork before you leave the building. Protection move number 4 is about your biggest asset, your home. And this is where the IRS gives you a massive legal loophole, but they put a brutal expiration date on it. If you own a home that has skyrocketed in value over the last 30 years, you probably know about the home sale exclusion. Under current tax law, a married couple can sell their primary residence and exclude up to $500,000 of pure profit from capital gains taxes. It is one of the greatest wealth-building tools in the American tax code. If you bought your house for $100,000 and it's now worth $500,000, you have $400,000 in gain. If you are married, you can sell it and pay 0 federal tax on that gain. But remember the widow's penalty? That applies to real estate too. A single person only gets a $250,000 exclusion, half the amount. So what happens when a spouse dies? The IRS gives the surviving spouse a ticking clock. Under the law, a widow or widower can still claim the full $500,000 married exclusion, but only if they sell the house within 2 years of their spouse's death. This is so critical. I see widows who live in massive, empty, expensive houses for 5 or 6 years after their husband dies. They stay because they are grieving, they are comfortable, and they are afraid of the tax bill if they sell. Then in year 7, they finally decide to downsize. Because they waited past the 2-year window, their tax exclusion drops from $500,000 down to $250,000. Suddenly, they owe tens of thousands of dollars in capital gains taxes that they would have completely avoided if they had sold in year 2. If you are a surviving spouse, or if you are helping a parent who recently lost their partner, you have to factor that 2-year deadline into your planning. And there is one more real estate secret you must know called the stepped-up basis. When your spouse passes away, the value of their half of the house is stepped up to the current market value on the day they died. This wipes out decades of phantom capital gains. If you live in a community property state like California, Texas, or Florida, both halves of the house get a full step-up in basis when the first spouse dies. That means a widow in Texas can inherit a house that went up $1 million in value, sell it the next month, and owe absolutely 0 capital gains tax. But again, you have to understand the rules of your specific state, and you have to have your home titled correctly before the tragedy strikes. Let me bring all of this together. The system is not going to look out for you. The county is not going to remind you to step up your property basis. The bank is not going to remind you to add a transfer on death form. The Social Security Administration is not going to mail you the Medicare appeal form, and the IRS is certainly not going to suggest that you convert to a Roth IRA to save yourself money. The entire financial system relies on you being passive. It relies on you assuming that someone else will handle it, or that the rules will naturally be fair to a grieving widow. They are not. Being legally exempt from a penalty is worthless if you don't actively take the steps to claim your exemption. You have to be the CEO of your own retirement. I know this is heavy. I know nobody wants to sit at the kitchen table and plan for the day their spouse dies, but I promise you the greatest gift you will ever give your husband or your wife is leaving behind a financial house that is bulletproof, clean paperwork, protected accounts, and zero unnecessary tax traps. Because I want you to get this right, I put together a free guide. I took the Roth conversion steps, the Medicare for MESA 44, the bank protection rules, and the real estate deadlines, and I put them into a single comprehensive checklist. It is called the 2025 Widow and Retiree Protection Checklist. It is completely free. It's not a sales pitch, it's a survival tool. Go to the link right down in the description below this video, enter your email, and my team will send it directly to your inbox in 60 seconds. Print it out, sit down with your spouse this weekend, and go through it one item at a time. If this video helped you today, hit the like button so the YouTube algorithm knows to show this to more retirees who desperately need to hear it. Subscribe to the channel if you haven't already, because next week, I am releasing a new video on the exact estate planning mistakes that are allowing the IRS to seize family homes. Do not let the government take what you spent a lifetime building. Learn the rules, protect your family. I'll see you in the next video.